This presentation is on the exchange rate. It should be watched in relationship to the presentation on the trade balance, because the exchange rate and the trade balance are of course mutually connected and affect each other. The exchange rate can be defined as the price of a currency in terms of another currency. This is the best way to look at the exchange rate. For example, if £1 equals €1.20, that is the exchange rate of the pound against the euro. It can also be seen as the price of £1 in terms of euros. So we can say that the price of a pound in euros is 1.20. Just like any other price, the price of a currency is determined by supply and demand, and the market in which currencies are traded is called the foreign exchange market, sometimes abbreviated to the Forex market. So we can see that if supply and demand determines an exchange rate, any movement in supply or demand will cause the exchange rate to change. So if we consider a supply and demand curve, and we say that for some reason the demand curve of the currency shifts to the right, it's clear from this diagram that the exchange rate of the currency will in fact go up. This is called a currency appreciation. We call this a currency appreciation. So if the pound was valued in euros at €1.20, it will appreciate if the exchange rate rises to €1.30. On the other hand, if the supply curve, for example, of the pound was to shift to the right, it's clear from this diagram that the exchange rate would go down. This is called a depreciation of the pound. So this is called a depreciation of the currency, in this case, the pound. So if the pound was valued at €1.20 and it fell to €1.10, that would be a depreciation of the pound against the euro. So these are the words we use: appreciation and depreciation of the currency. So we have to ask ourselves, what causes the demand or supply curve of the currency to move, and therefore what moves the exchange rate? Perhaps the most important short-term factor is relative interest rates between the two countries that we are talking about. So for example, if we're talking about the pound against the euro, we would be looking at relative interest rates between the United Kingdom and the Eurozone. So if UK interest rates were to rise relative to those in the Eurozone, there would be an inflow of hot money into the United Kingdom from overseas. Hot money is defined as money which is looking for a high rate of return. So if the UK interest rate rose, the rate of return offered in the UK to investors would also rise, and this would cause an inflow of hot money. As hot money came into the United Kingdom, demand for UK pounds would in fact increase, the demand curve would shift to the right, and there would be an appreciation of the UK pound. So this is one thing that changes the exchange rate. It's the relative interest rate between one economy and another. This is in fact a short-term reason for exchange rates going up, because relative interest rates change usually over a period of months. So this is relatively short-term. There are, however, longer-term reasons for a change in the exchange rate. And one of the biggest ones is confidence that foreign investors have in the future of an economy. The confidence of foreign investors is driven by the prospects of economic growth and by the policies pursued by the government and the central bank. So if foreign investors are confident that the fiscal policy of the government and the monetary policy of the central bank are in fact coordinated and synchronized, if they feel that both of these policies are designed to keep inflation under control and will lead to economic growth, then they will be happy to invest in that economy, and there will be a demand for the currency of that economy. Another long-term reason for exchange rate movements is intervention by the central bank. Sometimes central banks actually actively support a currency. They support their own currency by buying it on the foreign exchange markets, or they manipulate the currency in other ways and for other reasons. Some countries operate what's called a managed float. That is to say, they don't want the exchange rate to go up and down just with market forces. They want it to stay within a relatively narrow band. And this could be the reason why they intervene in the foreign exchange markets. Other reasons are connected with trade. For example, the Chinese government intervenes in the foreign exchange market to keep the value of the Chinese currency artificially low, because this helps their exports. So this is a longer term reason for movements and the level of the exchange rate. Central banks of countries actually intervene to keep the exchange rate at a certain level for various reasons. So what we can see is that there are many reasons why the exchange rate moves up and down over the short term and over the long term. A short-term reason is relative interest rates. When these change, they change the exchange rate over the short term. Longer-term reasons include investor confidence in the economy and government policy. So all of these are influences on the exchange rate and may cause a currency to appreciate or depreciate against another currency. Remember also that there is an automatic stabilizer effect. So exchange rates are influence other things, and those other things have a feedback effect on exchange rates. Nowhere do we see this more clearly than with the trade balance. So when the exchange rate changes, it will affect the trade balance, but the change in the trade balance will have a feedback effect on the exchange rate, and that will also affect the trade balance. So this has been seen as an automatic stabilizer effect. This is described as an automatic stabilizer effect, and we can briefly describe it now. Imagine that UK interest rates go up. Therefore, this will cause the pound to appreciate. The appreciation of the pound will cause the value of exports from the UK to fall. And as the value of exports declines, the demand for the pound will fall, because people are not buying so many of the country's exports, so they don't need so much of the country's currency. But as the pound falls, it will make exports cheaper for foreigners to buy. And so as exports become cheaper, there will be an increased demand for the pound, because people will want British pounds, and so the value of the pound will tend to rise again. So this shows that there can be a reciprocal effect between the exchange rate and the trade balance. So we have to be a little bit careful when we talk about the exchange rate, because sometimes there are these two-way effects going on, and it's difficult to know which one influences the other. So it's better to start with the things that influence the exchange rate independently, and then talk about how that affects the trade balance, before talking about the feedback effects.